here. So today we've got Steve LaCrosse, broker on the team, myself, Brian Ladd, and we have Jamie hiding behind the screen. But if Jamie, would you mind bringing up the mentee poll? I think that's going to be a fun way to inform our discussion today on what we're going to talk about. So we love doing these mentee polls. They're fun and are interactive, and QR codes, pick up your phone, scan that there. And what we'd love to hear is just top of mind. Someone says, hey, how do you feel about real estate right now? What's the first word that comes out of your mouth? What's your gut reaction? And that'll help us address the sentiment of what we're seeing in real estate. And then we'll also talk about what we're hearing from our clients as well. Anxious, confused. Steve, is that in line with what you're hearing from your clients as well?
Yeah, absolutely. I mean, people are seeing, we've talked about it before in our webinars and our market updates. They see headlines, they hear neighbors, they hear people down the street talking, and it can be confusing. There are data points that we're going to go over that could look very alarming, and it's not until you go through the subtleties of all of them that you kind of get a bigger picture of what's actually going on. But yeah, that's right in line with what we're hearing.
Yeah, perfect. Well, we've got a lot of people that are already here. So as you join us today, thank you. We're going to make it very quick today. We've just started. We're going to go about 20 minutes max. Q&A chat is open for you to ask us questions. We'd love to have a two-way discussion. To start, this is interactive. This isn't a dead slide. If you've got your phone, if you don't mind scanning that QR code on the screen and letting us know one word, how you're feeling in real estate. A few more of these pop up, then we can get on with the discussion, and it'll help inform where we go today. Conflicted, absolutely. Strong. It's all over the board, and all of these are very valid emotions, and these are things that we've felt, all of them, on a daily basis since January of 2020 when COVID started. We had, what do you call it? From 2013, 2014 to 2020, we had a relatively calm, consistent real estate market. And in the last 3 years, it has been anything but. So all those emotions are very valid. And we believe that we have some good data points. We've worked really hard to help people help guide people through those couple of years. And I think we've done a pretty good job at helping them maintain a bigger picture on real estate, what it means in their life, how not to make emotional mistakes. And if you're going to make actions, make it based on data. And that's what we're going to talk about today. So strong, opportunity, confused, conflicted, anxious, optimistic. I feel all those things as well, but let's get to the heart of the matter. Jamie, would you mind switching me over here? Perfect. I'm going to pull up our slideshow today. So you're with a lot of people. So this first slide talks about the percentage of Americans who think prices will go down over the next 12 months. I'm not sure if anyone can remember how they felt a year ago. It was a lot more pessimistic. And we have to remind people of that. A year ago, about 40%, and in November, December of 22, it was actually even a little worse than that. So about 40%, almost half the people thought the prices were going to go down in the coming years. In the coming year, prices didn't. And now we're down to about a quarter of the people think prices will go down in 2024. That said, caveat on that, it doesn't fall much below about 25%. There's always 1 in 4 of us that thinks the world's going to end and housing prices are going to fall. Sometimes they have that angle in their mind because they want them to fall. But a year ago, Steve and I looked at the data and had to swallow hard when we said the prices aren't coming down, because the world was wanting them to come down. With interest rates went from 3% to 8%, the cost of acquisition doubled. There was a fear of recession on the horizon. But when we looked at the data and talked about real estate in bigger perspectives, decades, century, what affects pricing, supply and demand, what are the forces affecting bend, we had to very publicly say in our newsletters, in our state of the market, in these webinars that, hey, we don't see it. Prices aren't going to fall in 2024, 23. And we were out there on some thin ice, Steve. But I think we got that one pretty right. How did you feel a year ago, Steve?
Yeah, absolutely. I mean, I think it's pretty consistent. People felt like we had such a run up in prices, activity was through the roof. The only logical thing was that, like you said, interest rates went from 3 to 6. The only logical thing was that there would be a correction. And the piece that we kept coming back to was it's possible, but there's another half to that equation. The other half is how many homes are available, how many homes are coming to market. It's a supply demand balance. And that's at the end of the day what determines that price, not what it did last year, not necessarily what interest rates did today, but how does the balance fall between buyers and sellers? And so it did turn out exactly as we had expected, which was the market stayed steady. So here's, Brian, if you want to talk about what that median actually did over the course of the last year, despite 37% of the people thinking that it was going to come down year over year,
Yeah.
we're up.
We were up about 4.8% year over year. And right now, our median price for all product types is about 690. But that has a pretty big ebb and flow every year. Down, if we were to just say, hey, a rolling 12-month average as opposed to 3-month average, we're about flat. But what we historically see, and we've talked about this time and time again, there's always an ebb and a flow of every year that's between 6 and 8, sometimes up to 10%, where we have our peak pricing in June, July. Really, those are April, May sales. And then we have our trough pricing, which is November, December, January. And it's not necessarily that prices are going down 6, 8, 10%. It's often that the homes that are selling that time of year are less expensive homes, et cetera. But what we've seen is a very normal year. Obviously, prices are way up from 2020 at the beginning of the pandemic. But what we're finding, and we were just talking about this before we went live on the webinar, is that we have a fairly soft normalization or soft landing normalization to the real estate market after a wild couple of years. And what I'm seeing ahead of us is a lot of things that fall within the parameters of normal. And I'm not sure how you feel about it. I love normal in real estate. I don't love crazy markets, up, down, sideways. There may be opportunities in those markets, but that's when greed, that's when bad decisions, that's when emotions comes into play. And I feel housing, especially primary housing, residential, isn't any of those things. It's the foundation for people's financial future, their lives, their stability, where they want to grow, they want to raise their families. And normal is a really good term to come to that. And I think that we have a very reliable normal year ahead of us, and we'll get into the data why. But I'm very reassured by what I'm seeing, and the fact that we unwound what happened during the pandemic so gracefully, it speaks a lot to the strength and the reliability and continued demand on Bend. I would love lower prices for a lot of people, and we have to get in. We've done a lot on housing availability and planning and things like that. But free falling prices isn't in anybody's best interest either. So that's what we saw for the year. Fairly, normal outcome. And this is about what we see. Steve, do you want to talk about this a little bit? Kind of month over month?
Yeah, absolutely. So that last chart was showing how the pattern of median price has moved over time over the last number of years. This is breaking it down on a month over month basis. So the dark gray, that's the 49-year average. The green, obviously, that was 2023. So month to month, from December to January, January to February, we see normal. Again, it's that pattern. It's that same pattern that we see every year. Last year, we had a few more extremes. We started off the year a little weak. We had a month over month decline from the month of December to January, but then in the months of March, April, May, we outperformed and outpaced what that average is. And so if you look at it for the year, the extremes were a little bit wilder than the average, but as a true average would indicate, that pattern is extremely similar. And so when you do look to what's happening in the market and what people are talking about and what interest rates are doing in these unprecedented moves, at the end of the day, more times than not, you look back at the data and it still follows a very predictable pattern, certainly from what we see locally and then also obviously nationally.
Yeah, so I got two great questions popped up in Q&A. Thank you. I love that. One, how does the recent CPI information play into this? It does in a big way, because it's also going to play into continuing inflation fears. The interest rates may not be dropping as much as we thought. The dropping interest rates is driving the increased buying activity that we have this year. And I'm going to put a pin in that because we're going to come back to that and talk for sure. The second part of this, Jim, you put a note saying, hey, many years the highest prices were in April, May, June. Do I see that happening again this year? Yes. If you go back and look at like a 15-year average, every year has this ebb and flow, and like clockwork, peak prices are in that May, June of every single year. And generally that's when buyer demand starts. And for a lot of our sellers, this is a really significant point. Most sellers are 2 months late to the market. In most buying activity, the peak of buying activity happens every year, starting in March, April, and into May. This is when the most amount of buyers, most amount of transactions are happening. The problem is most homes hit the market in May, June, July. So what happens is we have this increased buyer demand, and then the inventory comes late. And as buyer activity starts petering off, inventory continues to grow. And that also plays into why we see those lower prices in the fall and winter. So yes, I do foresee that the peak pricing, like always, is going to be in the spring. And sellers, don't wait for that June, July, because a lot of the times people just look at the data and say, hey, June, July has the peak sales every year. That's really closings. That's based on April, May activity. So yes, thank you. Good question, Jim. Let's get to our next one. Price forecast through the nation. Or no, this was price activity for 2023 in the nation. Up across the board. The only one was Portland out of all these big metro areas that had negative price appreciation. It was down about 1%. And we all know all the struggles that Portland has had the last year. And they've been fighting a lot of those things, and they're resolving some of those. But across the nation, it was not nearly the big price correction crash that people thought. And in fact, it's in line with our 50-year historical average. I think nationwide historical appreciation, I think, is 4.7, 4.8%. And that's about what we saw across the nation, which is at 5.1%.
Yeah.
Go ahead.
Sorry, I was just going to say, it's interesting looking at that list. Our big feeder markets, Southern California, Northern California, Seattle, Portland was the only one on there that was down. And some of those Southern California markets, San Diego and LA in particular, were 7.5% and 8%. So we do have a strong base of where our buyers are coming from. They're able to sell their houses down there at a profit, and they're coming here ready to purchase.
Yeah, and even though we've gotten expensive here, their appreciation's outpacing our appreciation, right?
Yep.
Sorry to step on you.
Yeah, absolutely. No, that's exactly it. And so then when you look at what the experts are saying for this year, trying to forecast what we expect to see this year, we will see that even with the experts, these change, right? So if you look back, the original forecast back in November, and we'll talk about interest rates later, but interest rates are obviously a big part of how people are basing their decisions and their expectations. But back then we had interest rates pushing the 8% range, and people weren't overly optimistic on what the expectations would be this year. That has, at least in the early half of the year, they had kind of changed their tune on what they were going to be doing for the Fed funds rate, and that there'd be some cuts coming instead of some raises. And now we're looking at, forecasts anywhere from 2 to 5%, which, back to what you said, Brian, right in line with what normal expectations will be. So certainly encouraging from that standpoint.
Yeah, and I think the question that Jim or the other person had about the CPI, what he's referring to is the consumer price index. The basket of goods are showing to have more inflation than they predicted. The PPI producer price index just came out, I think today or yesterday. It also was above expectations. How that plays into things is that the Fed is going to probably be less aggressive on dropping interest rates throughout the year, which is probably going to hold mortgage rates a little bit higher, which is going to slow down sales a little bit more. So what we'll probably do is have a little bit delayed push. And this year, maybe the push of peak buying activity might come a little bit later, because what we've seen over the last couple of years is with these high interest rates, so many people can barely afford to move into the real estate in real estate in Bend. And when we see a dip from 7.5 to 7.25, or 7 to 6.9, or we see immediate buying activity, and we have a couple week run. And then as those interest rates float back up, it also quiets down. So the demand is there, and they're watching those interest rates like a hawk. And so the big picture is maybe it slows it down for another month or two or a quarter. But what we're seeing is pretty unanimous, collection of thoughts around decreasing interest rates throughout the year. It may slow down that. And then we could also get into the discussion of the spread between the 10-year and mortgage rates, and the Fed doesn't set mortgage rates. But it's a good point. It could slow down some of this. I don't necessarily think it's going to change the forecast on prices. I think it's just going to delay the peak buying months of 2024. Does that resonate with you, Steve?
Yeah, absolutely. No, we fully agree that we will expect to see that same pattern. And like you said, whether it's a month delayed or a month early, the other piece of this equation, and it seems like such a trivial thing to say, is weather can drive activity in Bend. And so if we have a longer winter, a more cold, snowy winter, that can affect things as well. So there are a bunch of elements to it. And then, the biggest one, and we'll get to it later, is why are people buying and selling outside of interest rates, outside of, median prices? There's usually a fundamental reason people are doing this. So, but we'll get into that.
Yeah. So Steve, why don't we talk about kind of what happened with pending sales last year? Because I think I'd like to talk about sales pace and inventory, and then how that leads into what we're seeing, and why prices didn't drop, and why we're feeling that we have a pretty reliable year ahead of us.
Yeah. So a couple things we'll say about pending sales. So this is a 6-month rolling average. Again, you can see that pattern is pretty tried and true for every year leading up to that spike, which we all know what that spike was.
Yeah.
Since then, we are still seeing cyclical patterns. So on a seasonal basis, we are still seeing those same patterns. They're just varied in depth, they're varied in height. And, we are significantly under what we would normally expect based on historical averages. One thing that we will point out, and it is in our latest state of the market report, which is just getting back from the printers now, is what we ended up seeing in the pandemic was that people that were buyers that were potentially going to buy down the road, they spurred into action. So instead of buying in 2023 and 2024, that led to earlier action. Let's just do it. Time is now. That's where you see that spike. And so then when you factor in some of those people that would have been buying in 23 or will be buying in 24 that already purchased in 21 and 22, that leads to the drop off that we're seeing. And so if you looked at the total numbers of that, and you balanced out that peak with the latest trough that we've been in, it still rings pretty darn true,
Yeah.
in terms of an ongoing pattern.
Yeah. And I think a lot of people are going to say, hey, if pending sales are down so significantly, why are prices not down? If sales, and it really has to do with the bottom graph. It has to do with inventory, and we're going to talk about the mortgage rate lock of why we don't see inventory on the market. But the time we saw prices absolutely run through the roof were the combination of late 2020 on the top graph, where sales went to a rolling 6-month average of 3,000 homes. And we had no new homes come on the market, and they just obliterated our inventory in a couple months. And that buying activity stayed strong for about 18 months to 2 years with almost no new homes coming on. And that's where the prices went up the way they did. Where we stand right now is still less than half of our normal inventory. Historically, on a 6-month average, we have about 1,500 homes on the market. I think right now we're at about 800. So we still don't have the inventory, and that's really what's providing that floor on pricing of why we're saying, hey, no matter what happens to interest rates, we don't see prices going down much because of that lack of inventory in our market. And there's kind of three talking points. And Steve, let's talk about these because this plays into mortgage rates and activity. But these are kind of three stories that we can talk about that hopefully will help you understand how we're looking at real estate.
Yeah, absolutely. So when you talk about switching costs, this is the idea that someone who is going to be making a change is going to have some cost that's associated with it. It's psychological, it can be economic. And this, like a good example of that is exactly what we're seeing with being rate locked. They're in 70% of people with financed with loans in place are under 4%. They've got to get into something that's closer to 6.5 or 7% right now. So there's an actual economic cost to making that switch. Then, the second thing on here, we talk about seller impatience. And so people have looked at the sticker shock of, how much homes cost and people wanting to move on with their lives, but they can't because they've been holding on to not going to get what they want for it, or they're going to have these switching costs associated with it. And so then they just stay put. They just sit back and they stay put. And that tends to build after a while of these things have happened in life, which leads to 3 lifestyle changes. Things happen in life. People get pregnant, they get divorced, they get married, they graduate, they take a new job. All of that builds up. And those are usually what is the primary impetus for someone to make a change, either buying or selling. It's based on a fundamental need, more space, less space, different climate. And so you take all of those things into account. We can see that there are people that are out there. There's built-in pent-up demand for both buyers and sellers. And really what we're going to be watching closely is what is the balance between the two.
Yeah, and what we've seen historically is that the people who interest rate does not affect are primarily the baby boomers because, majority of the baby boomers have a very little mortgage. And I think over a third of them have 0 mortgage on their house. So when they sell, they're not giving up the golden 3% mortgage rate. So it doesn't matter if they move around in the market. And that's where a lot of our sellers came from last year. The big thing that we're seeing this year is the seller impatient and lifestyle changes. A lot of people were saying, hey, I don't want to do it. I don't want to change my interest rate. There's not a lot of homes to look at. What we found, Steve, in the last couple of weeks is our phone is ringing off the hook of people are saying, I had that kid. I need that bedroom. Our house is too big. Our marriage has changed. And things are happening. And we're seeing a lot of discussions about selling in 2024 that were not happening in 2023. So we do see inventory growing in the year ahead.
Absolutely.
And so we're almost done. I just want to talk about mortgage rates. And I hate talking about mortgage rates because I like talking about housing as a bigger part of one's life and investment and family. But mortgage rates have been the story for the last year since they went to the rate they're at. What we're finding across the board, Doug Duncan from Fannie Mae, everyone feels that we're going to moderate. They already have. And that by the end of 2024, a lot of people are saying they're going to be right at or below 6%. Whether that inflation, if inflation comes back stronger than expected, it'll just kind of kick that can down the road, whether it's Q4 of 2024 or Q1 or Q2 of 2025. Most people are predicting that over the next 12 months, we're going to have a pullback almost up to 1% in interest rates. And with that, we're going to free up a lot of sellers who were reluctant to give up lower rate loans. And then it's also going to allow buyers back into the market that were edged out by those higher rates. So we're going to see increased buying activity every time those interest rates notch back down. We just had an update from one of our lenders this morning. They're right about 7% again. We were at about 6.8 for a 30-year loan, 6.8. And they've edged back up to closer to that 7% mark. Kind of depends on buyer qualifications. But the consensus is pretty tight on this. There's not many people saying that we're not going to have some interest rate relief as we go through the year.
And on that note, I'll just piggyback this next slide, which shows what the expectations are across multiple groups, all of the experts. I will say as well, Fannie Mae conducted a survey, and 31% of the public also believes interest rates going to go down. So there isn't a disconnect between what the experts are saying and what the public believes. So it's all in alignment for an expectation that it will head in that direction. The projections show anywhere from a full point to 3/4 of a point rate reduction over the year. This is something you should talk to your lender about. talk about the various options on what you can do with that, what makes sense for you. You obviously have to be able to afford your payment where rates are at today, but it does look like there will be some expectations of some future rate relief.
Yeah, so let's put a bow on this. We had one more question saying, hey, are the things that we're talking about, would they also apply to multifamily housing? Yes, the prices that we're talking about are a basket of all residential property, including condos, townhomes, etc. It's actually probably a little bit stronger on the single family residences as far as sales and price this year. But we're seeing a similar trend across all product types. And we've still had that, what they call missing middle. We have a lack of good inventory as far as condos and townhomes at affordable prices. We've done a lot of conversations on my podcast. I've had some really great conversations with Brian Rankin, who's the long-term planning manager, Lynn Connolly, who's the housing director for the city of Bend, Melanie Keebler, who's the mayor. And we got deep into those discussions about when we can expect to see some of that and what are the tools that they're giving developers to provide more of that housing. So we've had good, fun discussions. Unfortunately, I don't see much relief on that in the next couple of years. They're going to try. But I do see it across all product types. Steve, do you want to kind of take it away here with what we're seeing for buyers, and then I'll close it with sellers, and
you bet.
We'll go take a walk on this sunny day.
Sounds good. Yeah, so it's been our consistent recommendation, and luckily over the last year and a half we've been able to people have been able to be a little more patient, take a look at a few more homes, get a real good feel for areas, make a good decision. There is a point in there where we do need to be cautious of being too patient, right? As interest rates, if they do continue to fall, more buyers step in, things can get a little more competitive. So that's the be patient, but also be ready. Have your ducks in a row, have your pre-approval ready from your lender, know what your options are. The end of the day, we talked about this a few times already. It's have a long-term outlook and a plan. Housing should not be looked at in the term of months or even years. It's more in the decades. And when you look at what home appreciation has done over the course of time, 300% over a 30-year period, 100% over a 10-year period, historically, it has been one of the most consistent and stable investments people can make. Interest rates, like as we've talked about, they have been starting to decline. If you're purchasing now, there could be options for refinance in the later this year or perhaps in following years. There are options you can get rates to buy down, and then when they do get lower in a couple of years, you can take advantage of that. Obviously, you need to afford your payment today. And then finally, the sale to list ratio is about 98%. That's a historical average yet again. Somewhere between 96 and 98 is what we historically see in Bend. This means two things. Buyers are not having to overpay, compete, outbid each other. Overall, there's a little bit of negotiation that takes place. The other half of that, sellers have gotten more realistic with their pricing. So, as sellers get realistic and they don't start super high, they start with a very not affordable, but a very reasonable market-driven price. It allows for a small amount of negotiation, but it's still holding tight. There aren't very many options to be buying things 10 and 15 and 20% under asking. So if you're a buyer that's waiting for a discount, I think we should just kind of get comfortable with the fact that we're in those historical averages of 2 to 4% under where people are asking.
Yeah, and so it's more exciting to be a buyer than it has been in a long time in a possibly falling interest rate environment, and you have some negotiation room. But what I like more than anything is time to make a good decision, in the sense that you can't sit on the sidelines, but when you make an offer on the property you want, it doesn't have to be a no inspection, no contingencies. I'll buy it. I'll put an escalator over other offers. You're able to make a wise decision and say, at this price, does this house fit my life? Okay, and I have a reasonable expectation that if I put together a good offer, that we're going to be able to acquire that home, as opposed to 2021 and 2022, where people were having to make very emotional reactions to even be in the game, and that's not what I like. So as a buyer, I like this environment a lot more. As a seller, the inventory is definitely low. So your home, even, we're about half of that historical average. We were talking about that. But more sellers are coming to market. And like we said, with lemmings of being a buyer of, and I don't even know if lemmings jump off the cliff at once. It's it's a story, a metaphor, but with buyers all waiting for the interest rates, and as soon as the interest rates, they're all going to be buying at the same time, we're going to see a lot of people try to sell at the same time. So what we feel is that buyer demand is still strong, and that leading that, like we were talking about in the March, April, May of this year, might be advantageous as opposed to waiting till everyone puts it on once the kids are out of school, et cetera, and then all those properties hit the market at once in June. So I think being a leader in this as a seller is going to behoove you in shining your home in the best possible light possible. Like I just talked about, list sooner than you may think. And then what I also like to say is, hey, buyers, put it in a big time perspective. Like when I bought a house 10 years ago, I can't remember what prices happen in the next 6 to 9 months. But as a seller, everyone wants to sell at the absolute peak price. And when you look back and say, hey, since the start of 21, prices are up 40%. Let's look at a big picture on the exit. I'm not saying give the home away or don't maximize your sale. But a lot of times people will lose perspective over 1 or 2% and price it over. And sometimes competitive homes to theirs will sell instead of theirs because they were going for the 1 or 2%. And they just need to take that one extra step back and say, okay, where am I up 1, 2, 3, 5 years? And by securing a successful exit, finding a reliable buyer, not necessarily having to find the 1 out of 100, I can find 5 out of 100 and pick the best buyer that's most reliably going to move me to my next home. It allows you a little bit more, serenity in that transition process. So, Steve, I lied. We said 20 minutes. It's 30.
I mean, it was close. That's probably our best performance in terms of timing.
Okay. Well, anyways, thank you all. I appreciate everyone who joined today. It's always fun to see all those names pop up. Thank you for the questions. I know that Jamie put in the chat, and we'll also send it in a follow-up email. We just finished a really extensive report that our team has put a lot of hard work into it. We do this twice a year that is just data-centric, that'll help you understand kind of how you operate within real estate, and we'll be happy to email that report to you anytime. I saw one more Q&A pop up, and it says, thank you, gentlemen. Well, thank you for attending. Speaking to a screen and not having anyone there is no fun. So you guys go enjoy your day, and we'll do this next month as well. And if you have any subjects that you want us to include next month, when you get that follow-up email on Zoom, send us your input.
Thank you so much, everybody.